you ever wondered how companies like Zomato, Paytm, or Tata Technologies become available for everyone to invest in? The answer lies in a process called IPO, which stands for Initial Public Offering. An IPO is the moment when a private company decides to offer its shares to the public for the very first time. This marks a major milestone for the business, opening doors for everyday investors to become part owners. In this video, we'll break down the journey of an IPO from the initial decision to go public all the way to the listing day on the stock market. Before a company launches an IPO, it is typically owned by its founders, early investors, and private shareholders. These individuals or groups have supported the company from its early days, helping it grow and develop. However, as the business expands, it may need a significant amount of capital for further growth, new projects, or even to pay off debts. At this stage, the company considers going public, which means offering shares to the wider public and inviting new investors to join the journey. Companies decide to go public for several reasons. Raising money is the primary motivation, but there are other benefits too. Going public can help a company expand its operations, launch new projects, pay off existing debts, and increase its visibility in the market. It also allows the business to attract more investors and potentially grow faster. By offering shares to the public, the company opens up new opportunities for both itself and investors. First step in the IPO process is appointing investment banks and advisors. These experts play a crucial role in guiding the company through the complex journey of going public. They help determine the right share price, prepare essential documents, and ensure all regulatory requirements are met. Their experience and knowledge are vital for a smooth IPO process, making sure everything is set up for success. Once the advisors are in place, the company must get approval from regulators. This step ensures that all legal and financial requirements are met, protecting both the company and potential investors. Regulatory bodies review the documents prepared by the advisors, check the company's financial health, and make sure everything is transparent. Only after receiving this approval can the company move forward with its IPO plans. With regulatory approval secured, the company announces its IPO. This is known as the IPO launch. The announcement is a big event attracting attention from investors, media, and the public. It marks the official start of the process where people can apply to buy shares. The company sets a fixed period, usually 3 to 5 days, during which investors can submit their applications. This window is crucial for both the company and investor. The period during which investors can apply for shares is called the IPO subscription window. This window typically lasts for 3 to 5 days. During this time, investors study the company's prospects, decide how many shares they want, and place their bids. It's a busy period with lots of excitement and anticipation as people hope to secure a piece of the company's future. During the subscription window, investors place their bids for the shares they want to buy. Some may apply for a small number while others aim for larger amounts. If the IPO is popular, more people may apply than there are shares available. This creates a situation known as oversubscription, where demand exceeds supply. It's a sign of strong interest in the company and can lead to higher share prices once listed. Oversubscription happens when more investors apply for shares than the company has available. This is a positive sign, showing that the IPO has generated a lot of excitement and confidence in the company's future. When oversubscription occurs, not all applicants will receive shares. The company must then allocate shares fairly, often through a lottery or proportionate allotment. Those who don't get shares will have their money refunded. After the subscription window ends, the IPO closes. The company reviews all applications and begins the process of allocating shares. This step is crucial as it determines who will become the new shareholders. The allocation is done based on the number of shares available and the demand from investors. Those who are successful receive their shares while others get their money back. It's a moment of anticipation for everyone involved. Share allocation process is a key part of the IPO journey. The company carefully examines all bids and decides how to distribute the shares among applicants. If the IPO was oversubscribed, allocation may be done through a lottery or proportionate method. Successful investors receive their shares while others get their money refunded. This ensures fairness and transparency in the process. For those who do not receive shares, the refund process is straightforward. The company returns the money to unsuccessful applicants, making sure everyone is treated fairly. This step is important for maintaining trust and confidence in the IPO process. Investors can rest assured that their funds are safe and will be returned promptly if they are not allotted shares. Most exciting part of the IPO journey is the listing day. On this day, the company's shares are officially listed on the stock exchange. Investors can now freely buy and sell shares in the market. The share price starts to move based on demand and supply, reflecting the company's value and investor sentiment. Listing day is a celebration for the company and its new shareholders, marking the start of a new chapter. Once listed, the company's share price is determined by market forces, demand and supply. Investors can trade shares just like any other stock, and the price may rise or fall depending on how the market perceives the company's prospects. This dynamic environment keeps things interesting, as news, performance, and investor sentiment all play a role in shaping the share price. Simple terms, an IPO is a company's way of raising money from the public while giving people a chance to become part owners. It's a win-win situation. Companies get the funds they need for growth, and investors get the opportunity to share in the company's success. From launch to listing, the IPO process is a fascinating journey that transforms private businesses into public enterprises, opening up new possibilities for everyone involved.